Let's talk. Thanks for joining us here today once again for kind of another video in our podcast series. I'm joined by Drew Casey, CFP, here on our team. I'm Grant Williams, CFP, so just thanks for tuning in with us and hearing us drone on about boring financial stuff. Drew, today we're talking about kind of encouragements for young investors, which is, maybe something that often goes overlooked in our industry. I think a lot of wealth management firms are, for obvious reasons, kind of honing in on pre-retirees, retirees. They've got the portfolios, and I think we really try to be intentional here about addressing some content to younger investors who are building their wealth, trying to do the right things today to set themselves up for a nice size portfolio in retirement. So,
yeah, fairly typical. You've got potential clients who are in their 50s and they're saying, well, it's about time to start thinking about retirement. And the reality is that the early years are so important in investing. So
the right time to start thinking about retirement's like when you're 22, in reality, in our view. So kind of 4 encouragements today if you're tuning in. The first is, if you're young, start saving now and investing now. We really just touched on that. Number 2 is, out of sight, out of mind, make it automatic. We're going to talk about kind of the power of automatic contributions and what we're just seeing in the industry there. Number 3, this might make a little more sense as we get further down the video, but play dead. Play dead, Drew.
Okay.
Yeah. We'll let you take
Look
that
forward
one.
to learning about that.
Play dead. Have a plan and stick to it. And then number 4 is something that we hear a lot from our clients. Okay, I don't even have a budget. How do I save more? You're telling me I need to save $500 a month. How do I do that?
What does that mean?
What does that mean? Just people who aren't in our world every day don't quite know how to answer that question. So we're going to dive into that.
I look forward to learning about that from you today.
Right.
That's something I need to work on.
Anyone that knows us would know that Drew's the saver and I'm the spender, so he's just being kind. So let's jump in here just on kind of that first point of, if you're young, start now. We like to say when you're young, you don't care. When you're old, it's too late. That's kind of a one-sentence way to describe it. And we really want, with our young clients, with our young listeners, to encourage them to start right now. Get going now. When you are asking those questions in your 50s or whatever, it is often too late to really experience compounding and experience the benefits of all of that.
Certainly not in the same way, not with the same power that you have in your 20s and 30s. So,
and we've just kind of got a chart here. I'll let you take us through it.
Yeah.
It's kind of a simplified example, but
very simplified example, but really intended to represent the power of compounding and early savings. So we've got 2 investors here in this simulation. One saves $10,000 a year from age 25 to 35. Typically in your 20s, you're probably thinking, I can worry about that later. Retirement's 30, 40 years away. I don't have to think about that right now. This investor, number 1, saves for 10 years and $10,000 a year, and then never saves again. They stop saving at age 35. And then we've got investor 2. They start saving at 35, probably more typical for most people. They also contribute $10,000 a year, but they save from 35 to age 65. At age 65, both of those investors retire. No, investor 2 is invested 3 times as long, 3 times as much.
I just want to stop there. Investor number 2 invested 3 times as long for 30 years relative to the first person.
Yeah.
Okay.
Exactly. They both were assuming kind of a 9% compound annual growth rate on these investments.
That's kind of representative of an all equity return. You're in your earning years.
Fairly aggressive.
You're taking on the risk of the market.
Exactly. Although the metaphor would hold regardless of the return, we assume.
Right.
But let's say they both retire at age 65. Investor number 2, they've saved 3 times as much. They've got a nice retirement portfolio, $1.6 million. That sounds pretty good. Investor number 1, who hasn't worried about saving since they were 35.
Forgot about the account.
They saved a third of as much in terms of dollars invested. They've got a portfolio of $2.2 million at that same retirement date. So just goes to show you how powerful compounding is over a longer period of time. That first 10 years has a much greater outsized impact on the portfolio over the long run than the second period of time over 30 years. So
the 8th wonder of the world. The Astrodome. I don't know that I could name the 7 wonders of the world, to be honest with you. The Astrodome is, of course, not one.
Taj Mahal?
Taj Mahal is one of them.
Is it?
Hanging Gardens of Babylon? Anyway.
Great Wall of China, of course.
We're in trouble. Thank you, of course.
Which you've visited.
There's no way anyone will hire us after this. Number 2 here, the power of automatic contributions. This is so huge. I feel like people they get a bonus, and maybe then they think about investing then. Maybe they
I have a big lump sum. I can put some money in.
I can do something now. But, the real way to build wealth, I think we have found, especially overlaying the psychology of all of it, is automatic contributions. I feel like we always see this. First of all, you're evening out the ups and downs of the market.
Right.
You're capturing the market sometimes when it's down, sometimes when it's up. It just kind of depends.
Once a month, once a week, whatever. Yeah.
How often have we seen a client get a lump sum and then they say, "Well, I'm going to wait until the market goes down"? How often have we seen them kind of trap themselves like that?
And what do they miss in the meantime while they're waiting?
Yeah. The market goes up 7 out of every 10 days, pretty much, if you look back historically. And so if you keep telling yourself that when you get a lump sum, you just inherently miss out on the ups and downs, on the ups, more than the downs, I should say, of the market.
Exactly.
And you might just talk about present bias. I mentioned that word a few seconds ago, but...
I think we're just inherently psychologically biased toward our present selves, and making a contribution to a retirement account or even just a brokerage account that you're going to try not to touch and spend the money. That's a future self benefit, and so it can be hard to, when you get the bonus, make a conscious decision to take half of that and put it into an investment account because you're not benefiting your present self in the same way as if you go buy a new car.
Right.
So I think psychologically there's just
we don't want to wait for things.
You don't want to wait for things. Patience is hard. And so to put something on autopilot, make it automatic, just takes that variable out of the equation. It's funny, I think about this psychologically. We do this with expenses. We have no problem Netflix charging us $20 a month and just letting that run. That goes out of the account every month. And we so often fail to just make the same contribution
with our savings.
Yeah,
so. That's such a good point. That's such a good point. And I think we've been in that scenario with a lot of young clients who are trying to save and just educating them. Hey, if you're having trouble entering the market, just the real point is just getting started. How often do we just say, look, take $250 a month, just get it in there. And then you're going to start forgetting about it. And it's going to start feeling better and better the longer it goes on.
Yeah.
And then when you get a pay raise, you're increasing that to $350 a month or $450 a month. You're just it's the point of getting started.
Yeah. Often there is an element of like, well, I don't have enough to invest because I don't have $5,000 or $10,000. But really, like you said, I mean, a couple $100 a month is more than enough.
Pick up some shares of an ETF, and absolutely. So that's just something we run into. And then this, I thought we'd bring this slide up. This is a Vanguard chart. They make their advisor resources really publicly available. It's really nice. This is from 2024. But defined contribution plans, that really means, 401ks, retirement plans for the most part. They're really taking note here on automatically enrolling employees. If what you're looking at in this chart is that dark green is automatic enrollment. Of 4% or more, and that has scaled up to 60% of plans over the course of this chart. And then 3% or less has scaled down. So these plans are saying, hey, we got to get our people automatically invested because it's so powerful.
The 401k is really the premier exclamation point on this entire encouragement, is because that's the way the 401k plans typically operate. Whether you're automatically enrolled or you do it yourself and then are kind of on autopilot in the background.
So the way I look at that chart is like, if these, if big 401k plans with thousands of employees and, outsourced, mutual fund managers coming in and providing investment options for the employees and all these things, if these plans are doing that, if they're making it part of their best practice, like, it must work. There's some real power to it. So. Okay, number 3, I'll let you kind of hit this one because I know you love this Fidelity study.
Play dead.
Yeah. Are the best investors dead? We'll let you just touch on that.
In some cases, they are. A 2014 Fidelity study of the best performing 401k accounts under their umbrella.
Yeah.
They had an interesting conclusion. The best performing accounts from 2003 to 2013, they looked back 10 years, were those held by an estate, so the original account owner is deceased, or by participants who had not logged in and had totally forgotten about their account. Which just
didn't log in.
They were, those are under the inactive
or they were dead.
Label by Fidelity, for one or another reason. And so that just goes to show the power of We often tell clients not to look at their portfolios because of this reason, the psychological benefit of if you're looking at your portfolio constantly, you're constantly thinking about making trades and changes and reacting to the headlines. That can just be a dangerous game to play. Yeah. And in fact, statistically, in some cases, it's better to set an allocation. I know we're about to kind of go through this in detail, but set something on autopilot and then just forget about it.
Yeah, for sure. For sure. Well, no, let's go through. We can kind of just split these up. We came up with a list of how to make sure you play dead, if you will. But
some instructions.
I think you just touched on really the first one, which is whatever your allocation is. And look, it's probably more aggressive if you're younger, just as a rule of thumb. And it probably tapers to be more conservative as you get older. But whatever it is, make sure that you're comfortable with it and make sure it's one that you won't panic sell out of. In a tough market, that you're just rebalancing to it, you're sticking with it, you're not thinking, oh my gosh, I got to go to all cash. So, even if you're young and you think I'm thinking of a client of ours who they're very young, but they just they're nervous they're new to investing, they're nervous about it, and they have 20% bonds in their portfolio in their 20s. But we might not suggest that or start from that place, but if it helps get that person invested, then, that's what matters.
Keep them from panicking.
And keep them from panicking. That's what matters. And, you set yourself up for some flexibility there if you do hit a bad market and maybe you're 3 or 4 years in and you've gotten used to how the financial markets run. Maybe you're thinking, okay, now I can sell my bonds and buy equities when they're down, and now that I'm used to it, I'm okay going, all stocks for the next couple of decades or so. So it's whatever it is, just decide on something you're comfortable with and stick to it. Number 2, just set up those contributions to your employer-sponsored retirement plans. You've got to get that done.
Yeah, because that is an account we typically, if we don't act this way in all of our investment accounts, usually with the 401k, we do sort of play dead. Most people are not trading in and out of mutual funds inside their 401k on a regular basis. And so that's key, just to have that on autopilot.
Absolutely. One thing that is just really simple to do, if you ever get a pay increase or a promotion or anything like that at work, increase your contributions. If you get a promotion at work and it's 10% and you've been contributing 10% to your 401k, just say to yourself, I'm going to up my 401k to 12. I'm not going to take all 10% of that home. So
that's an easy thing to do.
That's one thing that's easy to do.
I think something also that's pretty crucial, especially if we're talking about after-tax investment accounts, non-retirement accounts, is to have an emergency fund. The amount of that may vary just person to person, whether that's 3 months of living expenses, 6 months, a year. But it's important to have that fund set up so that when life happens, when you have an emergency, when you have to buy new tires for the car or whatever it is, you don't have to dip into your investment accounts and disrupt the power of the.
That was a timely example given my recent tire escapade.
Well, mine as well.
Yeah. Drew and I both recently replaced the tires on our car at great expense and pain.
Yes.
And then just stemming from that, after you build up your emergency fund, we really like to encourage young investors to make contributions to an after-tax brokerage account. Retirement plans are great. There's often an employer match you can take advantage of. We want to do all that, of course. It's free money in there. But we really find that a lot of people forget about that, that brokerage bucket, that after-tax bucket, that we often call it. And that's it's the same thing as a retirement account, but it gives you flexibility. It helps to diversify your future balance sheet if you can kind of contribute to that account and let it ride. So,
this is a separate video really altogether, but
it really is.
We see clients sometimes who retire and they have only a 401k account, which has certain tax characteristics, but can limit your flexibility in retirement if that's the only type of account that you have. So,
no, it's definitely a separate video and. But it's important. You want to take number 6 there?
Yes. This is easy to say, harder to do. But regardless of the account type, retirement, after tax, the goal really is to buy investments that you plan to hold until your grave, is how we've got it on the slide, which is pretty dramatic. But the idea is to think long term. Take the Warren Buffett approach if you want to, quote somebody, buy quality companies and hold them for a very long time. So much of when we think of trading, especially for the younger generation, that really means cryptocurrencies or things that are short-term in nature, trying to take advantage of something in the short term and get rich quickly. And that's not the kind of investing that we're talking about here. We're talking about, investing in quality companies or mutual funds or ETF that you'll be able to hold. For the
That's
long
also
term.
maybe another separate video.
Could be
Chasing what's hot,
investment fads,
trading, and prediction markets, and crypto, and all that stuff. We don't think that's investing here, so we'll just kind of leave that as a teaser, perhaps. Number 7, last one here: rebalance or trade on a schedule. So try to avoid rebalancing or making any sort of changes to your allocation when you're feeling emotional if the market's down or just for any reason. So say, no, I'm only going to rebalance biannually or quarterly or whatever it is. Mm-hmm. We find that's a really good discipline. And all of those contribute to playing dead, as we've put it today. Well, good. We'll wrap up here. And the last thing we wanted to cover is, how do I save more? This seems like a simple question, but it's really kind of astonishing to us in our meetings how often we get it. And, really the main thing I think we would say is just a review of that cash flow and identifying areas where you can cut back. Yeah. Common ways we see, our clients trying to do this and maybe where we might encourage them to do it is eating out less. That's probably the number one
low-hanging
thing we hear. Wouldn't you agree? I
mean, something that's non-essential that you can cut back. You can save some money pretty quickly, pretty easily. As opposed to necessary bills and expenses that are harder to avoid. So
for sure. Monthly subscriptions. You kind of mentioned Netflix earlier.
They can just start accumulating in the background. You forget.
It's insane.
You don't do the math on, I only watch a movie a month from this provider, but I pay $15 a month.
It's wild.
That's a value decision for each and every person.
I'm sure that's probably hitting home with literally anyone that is still watching at this point, which is probably one or two people.
One or two people.
Yeah.
So much of our consumption of popular culture now is subscription based, and it can
eat away.
It can just chip away at your budget without you realizing.
For sure. So. I'm going to let you hit this one, and then I'll hit the last one. We just have 2 more necessary monthly bills, and kind of reviewing those to see if there are better rates. This is interesting what you and I have discovered in recent years.
It is. You've got some monthly bills that, rent expenses, mortgage expenses, insurance premiums, energy bills, things like that. Thinking specifically of a recent example, insurance is often a way that a bill that, we just kind of assume we see it and it is what it is. And, you can always visit with an insurance broker who will periodically shop a new plan for you. And just speaking from personal experience in the last year or so, that's a bill we typically think of as something we can't change, but has actually meaningfully made a difference in my own personal expenses.
Yeah.
And we don't often think of it that way. So that's something to revisit once a year, maybe on that kind of cadence.
I'll get slightly more aggressive with it. Drew and I use the same insurance broker, and it has been outstanding. I don't have to do any work. They handle my renewals every year. Yeah. He's a great guy and shops the market for me. And like last year, he, basically identified that I was paying 2 times what I should be paying for car insurance.
Yeah.
And it was just me being lazy. It was me getting busy with my kids and stuff at home and work. And I'm just not thinking about it. Oh, okay, I'll just renew my policy. And he, found me a new policy, and it is half what I was paying. And based on the policy limits and all this stuff, there's no real ascertainable difference between the 2 policies. And so he watches that, and
probably all you had to do was send an email.
I didn't do anything. I sent a DocuSign. Yeah. And so that might be something. Those brokers are paid by the insurers. And so it's nothing out of pocket. We're not endorsing any specific person or anything here, but it can be a really nice relationship. So that's something to look into.
I think one other thing on expenses, budgeting your mileage may vary whether that works for you well at times or poorly at other times, and every person's different in the way that they approach that. But I think something that is important is to at least track your expenses. Just so you know where the money's going. There are lots of popular apps that you can use to do that and programs, and that lets you kind of start to identify, okay, where am I spending money that I'm not even realizing I'm spending money in this category.
For sure. So that's a great word. That's important. Yeah. Data is valuable. Mm-hmm. Number 3 is just something I picked up on from a client who I kind of picked up on in the early years of our relationship, was a good saver. He does 1 month out of the year, he has a PB&J month. And just during this month, he does it like January, February of every year. And he just says, I'm going to eat peanut butter and jelly for like
Sure.
lunch and dinner every day. And does it. He's a single guy, does it.
Yeah.
And like that month is like his highest saving month of the year because he's
Yeah.
not going to Chipotle. He's not, going out to eat. He's not doing quite as much. He's just like, this is just going to be a little tradition for me.
It's a tradition, a little experiment.
It's a little experiment, but he always reports that he saves like 2 or 3 times as much as the other month. So if you're getting started and you just need someone to kind of kickstart you, who doesn't like a peanut butter and jelly? And, or sub in a turkey and cheese or whatever. But
one of the great gifts to mankind.
Yeah.
According to one of our co-founders.
For sure.
So.
Yeah, that's right. So, hey, that's something to consider is to institute a PB&J month out of the year.
I think there is an element to making something a challenge or a game to some degree can make it more interesting.
That helps psychologically.
It helps psychologically.
Absolutely. Couldn't agree more.
Yeah.
Well, hey, thanks again for the small handful of listeners that probably made it through this video. We're just glad for you to join us. And these are really, we have some fun with it, but these are really important topics and really crucial to cover for young investors who are trying to, park that money somewhere and see it grow. And hey, what you do now, what you can do today, 24 hours at a time, is what really makes the impact in the long run. And stick with the plan and stay the course, and don't sell out of it. And it's going to work out. We're going to work out for you given enough time. And so thanks for joining us. None of this is intended to be personalized investment advice. So please don't take it that way. We just want potential prospective clients and folks that follow us to get a feel for kind of the things we look at. So really appreciate you spending a few moments with us.